Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to look at a popular dividend company that has recently dipped. They just posted their earnings. It is a drug retail company that may be undervalued. Some of the key highlights on this one is dividend growth streak of 47 years, consecutive increases, 91 years, guys, of uninterrupted dividend streak without a reduction. Is this an opportunity to buy more or enter, or we're seeing more pains later down? Let's take a look and see if this is a good time to get in and invest in this company. As always, please remember, do your own research. It's not financial advice. With that said, let's take a look at this company. So the company that I'm talking about is Walgreens. Ticker symbol is WBA. It is a company that engages in pharmacy retail. It delivers health and wellness services. I personally like going to this place. It is a great place to just go get what you need and then go. There's other things to shop in there. As you can see, you can get from products that you use every day to medications that you need and all the other ones, contact lenses, beauty and health care for the ladies, and then you got your groceries. Yeah. Now if we go to Yahoo Finance, there was an article regarding the pullback, and they talked about how the vaccine might have played into it. So it says here that, and this was written by Josh, it says your stock sank on Tuesday as the company warned expected profits to be lower, anticipated events, the dwelling demand for the vaccine, and weakening consumer spending environment. So you can see right here, it says that it cuts its full year adjustment earnings per share from 4 to 45, ranging from this one. It slumped nearly 10%, closing at its lowest since 2010. So, and then looking at it a little bit more, you can see Walgreens has posted a revenue of $35 billion, slightly above the estimate of 34. Adjusted earnings per share of $1 was lower than the 106. Gross margin came at 18 for the quarter, below the street consensus of 20. And then if you look a little bit more, it talks about how the cautious consumer. So definitely take a look at that and read that stuff. So if we go to Google, you can see the 5-year performance is down 52%. The 1 year is about 30%, and then the year to date is about 22%. Now, if we swing over to Yahoo Finance, what I wanted to do is compare to the S&P 500. As you can see, for the 5-year one, it's really lagging. There's that big gap in there for the last 5 years. Same thing with the 2-year gap. So it's been underperforming versus the S&P 500. Going over to Stock Rover, based on analysis, they rate it as a hold. There's 3 buys, 1 strong sell, and 1 sell. Now, if we look over versus comparing it to the industry, risk and return based on the industry and the S&P 500, you can see, again, 5-year return, 3-year return is still lagging behind the S&P 500. Now, if we go to Seeking Alpha, I wanted to look at the 10-year performance, and then you can see right here, 10-year performance is about 35%. Looking over here, you can see some of the PE, 6%, EPS 4%, and then the dividend yield, dividend rate, dividend yield right here, market cap, and all that stuff. If we go over to look at the dividend safety score, you can see 79, which is safe. Again, the dividend yield is 6%. It is a large market cap. If we go down to the key metrics, payout ratio is about 47. Forward payout ratio is 42. Both of them are edging higher for a consumer retailer. Dividend growth, you can see the last 20 years, very fast, about 14% for the last 20 years. Last 5 years, 5%, which is average. You can see right here, 47 years of consecutive increases, rating all the way back to right here, probably 2003, and 91 dividend years of uninterrupted, which is pretty awesome. I'm hoping you're going to reach up to 100, and that would be great. Payment details: quarterly in the months of March, June, September, and December. Annual payout will be $1.92. Ex-dividend date is May 18. Looking at this one, they say it might be undervalued. Again, its 52-week range is close to the low. And then your PE ratio right now is 6 versus the consumer staples of 21. Looking at some of the financials, you can see payout ratios right here. Earnings per payout is right there, 45% the last 12 months. Earnings per share, free cash flow per share. And then you look at the sales growth. You can see right here, total sales, outstanding shares, and then you got your return on equity and your return on investment. You can see a little bit it went up, and then now it's starting to go down. Now if we go to the NASDAQ, a lot of people like including myself, love this company for its dividend. So if you look at the history of the dividend yield, the dividend history of it, you can see it slowly increases as the time goes, from all the way back to 2014. Just steady increase of dividends, you can see right here. So now if we go to bar chart based on their snapshot opinion, yesterday was a sell, last week has been a sell, and then for the last month it's been 100% sell. And then looking at the indicators between short term, medium term, and long term, it's just basically all sell. You can see from here, from the 20-day moving average to about the 200-day moving average. Sticking to bar chart, you can see based on their analysis, rated as a hold. For the past 3 months, it's been a hold. Currently, you can see 10 holds, 3 strong buy, 1 strong sell, and 1 moderate sell. Going to tip ranks, based on their analysis, they rated as an 8. Hedge funds trends have increased here. As you can see, they bought about 1 million shares last quarter. And then insider trading has also bought shares worth about 339,000 over the last 3 months. Now going to CNN Business, you can see based on their forecast, rated as a high of 52, a medium 37, and then a low of 28. Recommended analysis recommendations about hold, pretty much the same as the rest. Now if we go over to Motley Fool, there's another article that says that Walgreens could rise about 23%. Some of the key points that they talked about: shares are cheap, predicting good results in quarter 3 and quarter 4. Hasn't performed well recently, but it might change. So I want you to take a read this and look at it. The stock has declined over 27% over the last 3 years. There's a lot of key important things in there. Right now, it has 1.8 billion in cash, short-term investment. Talks also about right here, June 8, it announced the sale of stakes in Option Care worth about 330 million. And then it's also in May, it sold some shares about Amerisource around 644. So slated to use this debt for repayment. So you can read about it. It's really good about like how he's talking about all these other things. The PE, he says something about how it's you might have to kind of look at it and see if it's worth your investment. That's about it, man. My take on this is I'm a long-term holder of this company. I like the fact that it is on the dip, but I am concerned about the debt. I am going to buy dollar cost average on my position and see where it goes, but I'm definitely holding it on for the dividend and the because I am a consumer of this company. I do like it. I use the brand, I use the company to get all my products. So definitely go do your research and see if this is something that you want to put your hard-earned money at. With that said, thank you so much for watching. Hope you liked this video. Give it a thumbs up. Also, definitely when you have time, check out the other videos as well. Stay cool, keep investing, and I'll catch you guys in the next video, right? Take care. Aloha.